Good morning, everybody. It's a pleasure to be here to be able to talk at your conference. And just from what I've heard so far, it does seem to be that your organization is truly working hard in improving the competitiveness of Durham. And so that's definitely something that's a positive and will help you going forward. So what I'm going to do today is just share with you how we see not only the global economy developing, but also some key sectors that are important here for the region of Durham in particular. You highlighted the importance of the auto sector, so I have a few slides that will be specific to the auto sector and just really highlighting key trends in that area and some changes that are likely necessary in order to improve the outlook going forward. Here we go. Great. Okay, my first chart there then just shows you global economic growth, which is the red line on your left, and it essentially shows that when economic conditions are fairly healthy, you have global growth advancing by roughly about 5% on a year-over-year basis. That was the case through late 2007, and then, as you all know, we basically went off a cliff in 08 and 09. The good news, obviously, is that we bounced back fairly sharply, and so by early 2010, we were back to that 5% growth rate that we normally consider fairly healthy growth. Since then, we've been moderating somewhat, and I think the key point here is that while we have seen activity moderating, we are still growing in excess of 3% year over year. It's not as good as we would like to see, but if we go back historically, over the past 20, 30 years, the average growth has been around 3.5%. So not as fast as we would, but the point is we are still growing, and our outlook is that global GDP will advance by roughly 3.1% this year and pick up a little bit of speed next year. If you look back at that chart, the key area here is the emerging markets are really leading growth. That was the case prior to the downturn, and that is the case currently. The difference is that they used to grow in excess of roughly 8% year over year. They bounced back to that level, and now they have moderated to probably about 5.5% to 6%. But the key point is that that pace will continue. So it will be the emerging markets that will continue to lead growth. And if we shift over to the other chart where we're showing the regional differences, you can see that while economic activity in China has moderated a little bit, it is still growing roughly around 7.5% on a year-over-year basis. And all of the recent indicators that we have seen in recent months really show us that the pace of growth is beginning to bottom out in China. This morning we even got additional data, such as their industrial production, retail sales, etc. And in both cases, they were actually stronger than people were expecting. So all of the recent data confirm to us that we are seeing a bottoming out in terms of the Chinese economy. So we'll actually see a pickup in growth as we move into the fourth quarter. Canada and United States, we're basically growing around that 2% area, and that is our forecast over the coming year. The one area that is in a downturn is obviously Europe. As you can see, it is in recession. It is contracting. We do think that it will contract this year, and by next year, it'll be kind of roughly flat. So that is the one area there is real concern. However, keep in mind that if you look at the Eurozone as a whole, it only makes up about 15% of the global economy. So we have 15% that's contracting. We have the remainder of the world that is continuing to expand, and that's the key here. And especially, and if you look at employment growth, we're seeing that employment growth continues to grow in excess of 2% on a year over year globally. In particular, that is being led by the emerging markets once again. But the point is that that pace of growth, as you can see, is fairly healthy on a historical basis. So that's one factor that is very positive for us. The other factor, I combine that with the U.S. leading indicator, which is that blue line there. And the reason why I did that is the leading indicator does precisely that. It leads in terms of economic cycles and turning points. If you look back at the downturn in '08, you can see that that blue line actually turned negative in late 2006. So at least a year prior to the downturn in the U.S. economy as a whole. And if you look at the recovery, it basically does lead the upturn as well. And if we go back and look at all prior economic cycles, you get that same type of pattern. So that's why I put that there, because there are some indicators out there that truly give you a sense of where you're going. And what's important here is if you see that blue line there, we're actually seeing an uptick. So as of the third quarter of this year, we actually see that line improving. So that's telling us that the likelihood is you'll see a little bit of pickup in economic growth in the United States as we move into 2013. The other chart just really looks at global trade. We talked about how, on average, the GDP growth tends to be about 3.5% over the past several decades. Well, if you look at global trade, it tends to increase at a much faster pace. And so from 1991 onward, global trade has increased by roughly 6%. Okay? And more recently, even over the past decade, even with the global downturn in '08 and '09, we have still had global trade expanding by 5% on a year-over-year basis. And more importantly than that, if you look at that red line, it's essentially at new highs. So back in 2010, global trade activity actually surpassed the previous peak of early '08. I say this because when you talk to some people, there's still a lot of negativity out there, and some people actually believe that we're still in the midst of a downturn. We are in the midst of a slow economic recovery, not the downturn, and that's really where a confirmation of that for you. Now, one of the reasons why we are having some sluggish growth is precisely because governments in many countries have large debt overhangs. In particular, you see Europe, you see Japan there, where their debt levels are fairly high relative to their overall GDP. Fortunately for us, and as was highlighted, I think a little bit earlier, Canada has done a good job in terms of its fiscal position. Our debt to GDP ratio, I think, is in the order of about 35%, much healthier than the other G7 nations, and especially places like the United States. And so that will serve us well going forward. Now, this is probably one of my favorite charts. And the reason why I put this up here is it shows you when there are periods of financial stress in the system. And this is important because financial stress tends to precede an economic downturn. It is a leading indicator. Okay? If we go back to the latest downturn, you can see that green and the blue line, which are essentially, these are TED spreads. TED spreads are essentially the difference between 3-month T-bills and 3-month euro-dollar rates. And it's really a gauge of the health of the financial system as a whole. So the point is, as the spread widens, that's telling us there is tension or difficulty in the operation of the financial system. When that spread comes down, it's telling us that the financial system is functioning well. And as you can see, back in the middle of 2007, we got basically the spread widening out significantly. And that always happens prior to an economic slowdown. The good news as we stand now, as you can see, is that TED spread is at a very low level. It is telling us that here in North America, the financial system is functioning properly, and it is at a level that is conducive to ongoing economic growth. Look at what's happened in the Eurozone, which is the blue line there. obviously with the financial strains that they're having both at governments and their financial institutions. They had a big spike in their TED more recently in 2011. And it started to come down a little bit, so it's telling us that their system is a little bit better, but it is still not healthy enough to basically support growth. And that's one of the difficulties. So this is just a key leading indicator that you can sort of keep in the back of your pocket to take a look at from time to time, just to get an idea if there are difficulties in the financial system that we should really worry about. And generally when they are, as you can see historically, they are then followed up by some greater turbulence in the global economy. What I'm telling you now is, as we look at stress indicators, as we look at leading indicators, all of those are positive in terms of the growth outlook. And one other important point that's key here is that, especially in the United States, consumers are in much better financial position than they were back in 07 and 08. What we look at is the percentage of household income that's absorbed by energy and debt costs. And now by energy here, I'm taking both filling up your gas tank as well as heating your homes and etc. And back in 07, 08, you can see those two components used to take up roughly 20% of disposable income for a typical U.S. family. Given that interest rates have come down significantly, the Americans have really been paying off some debt as well in recent years. What we're seeing is that ratio, or it's now down to roughly about 16%. So what used to absorb 20% of their income now absorbs only about 16%. That's the lowest level in a decade, and it's really provides additional income for Americans to be able to spend on other things. And that's really why you have seen consumer spending pick up, is because of this additional income that is now available, which before used to go to pay for energy and debt charges. The same sort of trend with respect to the Canadian situation. The difference is that we peaked at about 15%, and now we're probably somewhere around 13.5%. So we haven't made as much progress. The reason is that we've continued to add to debt, and if you read the papers or see TV on a regular basis, that's certainly one of the warnings that the Governor of the Bank of Canada is consistently pointing out, is that there is a risk in terms of the Canadian households that their debt levels have continued to increase. At this point, what we're saying is, if you look at how hard it is for them to finance that debt burden, at this point, it's not problematic, but should interest rates increase, then it would be a problem. And I think that's really what the governor is really trying to point out to people, is it's fine in a low-rate environment. However, be prepared that we're not going to be in this low-rate environment forever.